Have you ever really wondered how someone becomes the most successful investor on the planet? Well, I can tell you it's not about some secret formula or taking wild risks. Today, we're going to unlock the code inside the mind of the legend himself, Warren Buffett. All right, let's get into it. Everything, and I mean everything, starts with this one simple but really powerful idea: forever. Now, this isn't just about being patient. It's a total mindset shift. It's about seeing yourself as a part owner of a business you believe in so much that you'd be happy to hold on to it for the rest of your life. So that's the billion-dollar question, isn't it? How did this guy from Omaha, Nebraska, so far from Wall Street, build this absolute empire and become a household name? Let me tell you, it was not luck. It was a clear, disciplined, and honestly, a repeatable philosophy. To really understand the code, you first have to understand the guy who wrote it. And his story, well, it started long before anyone was calling him the Oracle of Omaha. So he was born right in the middle of the Great Depression. Business was in his blood. His dad was an investor. And get this, Buffett bought his very first stock when he was just 11 years old. 11. But the real game changer was at Columbia University, where he studied under the one and only Benjamin Graham, the guy who literally wrote the book on value investing. That experience laid the foundation for, well, everything. Fast forward to 1965, he gets control of this failing textile mill called Berkshire Hathaway and starts turning it into the powerhouse we all know today. Okay, so this brings us to the real heart of it all. His success isn't some kind of magic trick. It's a code, and it's built on just a few timeless, incredibly powerful principles. Let's break them down. First up, the absolute foundation: value investing. The idea is simple. Forget the stock's price for a second and figure out what the business itself is actually worth. Its intrinsic value. Then, your job is to buy it for way, way less than that. You know, it's like finding a dollar bill on sale for 50 cents. You'd make that deal all day long, right? Next, he looks for what he calls a moat. Think about a medieval castle. What protects it? A big, wide moat filled with water. In business, a moat is a durable competitive advantage. It could be a brand that everyone knows, like Coca-Cola, or a cost advantage that nobody can compete with. A strong moat is what keeps the competition out and protects a company's profits year after year after year. And that leads right to this, the margin of safety. This is your safety net. It's your built-in cushion. Because, let's face it, none of us can predict the future perfectly. By buying a business at a huge discount to what you think it's worth, you protect yourself. If you made a mistake, or if something totally unexpected happens, that margin of safety is what keeps you from losing your shirt. Now, this slide is absolutely crucial. It highlights the massive difference between what Buffett does and what most people think investing is. On one side, you have investing. You're analyzing a business, you're thinking like an owner. On the other side, you've got speculating, which is basically just betting on which way a stock price will wiggle. Buffett has always been and will always be a business owner, not a market gambler. All right, so these principles sound great in theory, but how do they actually play out in the real world? Let's look at how he applied this exact code to two of the most famous investments in history. Okay, let's take Coca-Cola back in 1988. Check all the boxes. Was it a simple business he could understand? You bet. Did it have a massive moat? That global brand is one of the biggest moats on earth. Did it generate consistent cash? Absolutely. And people drink it whether the economy is good or bad. So he bought it, held on tight, and just let that value compound for decades. This one investment is a perfect masterclass of his entire philosophy. Now, let's jump to a more modern example. Apple. For years, Buffett famously avoided tech stocks, saying he just didn't get them. But around 2016, he saw Apple in a different light. He didn't see it as a complicated tech company. He saw it as a consumer products company with this incredibly powerful brand and an ecosystem that just locks customers in. That customer loyalty, well, that was a modern-day moat he could definitely understand. And when he found something he liked, he didn't just dip a toe in the water. Look at this chart. His conviction was massive. Apple eventually became the single largest stock holding in Berkshire's portfolio by a long shot. It just goes to show you, when Buffett finds a truly wonderful business at a fair price, he backs up the truck. So what's the result of applying this code day in and day out for over 60 years? Well, you get one of the greatest wealth creation machines the world has ever seen, Berkshire Hathaway. I mean, the numbers are just mind-blowing. From the 60s all the way through the 90s, Berkshire's annual returns absolutely crushed the market averages. We're not talking about beating it by a little bit, we're talking about being in a completely different stratosphere of performance year after year. So what was the secret sauce here? Well, one of Berkshire's biggest advantages was its insurance businesses. Think about it. They collect all the premium payments from customers up front, right? But they don't have to pay out claims until much later. That giant pool of money they get to hold on to and invest in the meantime, that's called float. And Buffett got to invest all of that float for Berkshire's benefit. It was a brilliant structural advantage that basically supercharged their returns. And the result for the shareholders who stuck around? Just look at that number. The growth of a single share is almost hard to wrap your head around. It's the ultimate proof of the power of finding great businesses, holding on for the long haul, and just letting the quiet magic of compounding do its work. Okay, this history is amazing, but what does it all mean for us, right now? Let's boil down Buffett's entire code into 4 clear, actionable lessons that any of us can apply. Here's what it all comes down to. First, think like a business owner, not a stock trader. You're buying a piece of a real company. 2, stay inside your circle of competence. If you can't explain what the business does to a 10-year-old in about 2 minutes, just stay away. 3, always demand a margin of safety. Insist on getting a discount. And finally, number 4, be patient. The real money is made by sitting and letting your investments grow, not by frantic trading. And that brings us to this final quote, which this might be the most important lesson of all. At the end of the day, Buffett's genius isn't just about numbers on a spreadsheet. It's about temperament. It's about having the emotional discipline to let your good ideas work for you while everybody else is running around panicking or getting greedy. It's a powerful reminder that in the world of investing, patience isn't just a virtue, it's a superpower.